And back to our regular discussion. It feels so good to be back on Saturday morning talking to you all. I missed last Saturday because I was traveling. So that I missed the routine of talking to the folks over Saturday. So, but I'm glad that I'm back and we are back on our regular schedules. So as always, if you have any questions, put it in the chat box, or you can unmute yourself and then we can talk through any of the questions that you have. Today, I want to look at a lot of roller coaster things that we saw in market, something coming from China, and also want to focus on an article that I read around investor risk profile and where the current policies are pushing us as an investor on the risk profile. Hope you like it. And of course, we'll look at some of the other things that caught my eye during this week. This was a pretty busy week from a work and from a family perspective. So didn't have too many things to do from a market, but I stay semi-active in the markets in terms of doing some options trades. Definitely didn't pull out anything. We saw markets on a roller coaster, but that's what markets do. They go up, they come down. We don't have to be bothered by it. Yeah. All right, so with that, let's get going. As always, anything that we discuss here is only for education, maybe a little bit of entertainment, maybe a little bit of philosophy, but definitely not a financial or tax advice. Right? So don't take it as a professional advice. This is just a friendly group. We want to talk about investment. We want to talk about how to be a better investor, and also want to talk about what's happening in the markets. So with that, let's get on to today's session. Yeah, this, before getting into the stock or the market side, it amazes me how the scammers are trying various ways to scam people out. This is an email I received just today morning, 15 minutes ago, saying suspicious activity detected on your Coinbase account. If you're not a vigilant investor, or or if you're not aware of these suspicious activity, these phishing activities, it is very possible that people will click on verify now and provide their credentials. The moment you look at it on the top, it's coming from some hacker or some scammers, right? From so many emails I receive, sometimes from a PayPal, your PayPal account is deactivated, click here to reactivate your account. Now, scammers are becoming smarter, right? More and more exchanges coming up, and now they're sending emails through, posing themselves as a Coinbase. So Ramesh, I also received it, just deleted. Got it from PayPal. PayPal has become very standard. Sometimes to me, it looks like that it just keeps coming on a regular frequency around PayPal, that your PayPal account is deactivated or some trouble. Yeah. Yep. Never ever click on any links that you receive in an email which says that account is compromised. So I thought I'll just share it here. I got it. This was like a fresh, hot off the press. Anyway, as always, let's start with the quote of a week. Those who are a little more active on the crypto side probably know this personality, Anthony Pompliano, with the laser eyes. But the reason I'm not talking about is because of its crypto, but the inflation numbers for August are out. CPI is at 5.3%, core inflation 4.0. We all know that the costs are rising and the asset owners are getting richer, right? Whether you're a financial asset owner or a real estate, any asset owners are getting richer. Those who are in regular jobs or business but not investing are just losing the cash, or your bank account is losing to inflation. So don't complain about it. Start investing. And during my last week trip, I realized that everything has become super expensive. Right from my ride from airport to home, I took an Uber, and I'm like, what? I'm paying almost 60% higher than what I paid for my Uber ride from airport to home a year ago. Not a year ago, it was in 2019 December, right? Close to maybe 2 years ago. It was like more than 60% more expensive. And then all the hotel, super expensive hotels. And of course, I had to rent a car again. I was just wondering, where is those, how the people who are not being focused on investing, and of course, your wage doesn't grow at the same pace at which the food prices are growing, at which the rental car prices are growing, at which the accommodation hotel room rents are growing. And of course, my fourth one was experiencing it through my Uber ride. Stop. Again, don't complain about it. Start investing. That's the only way we can continue to catch up with inflation. Savings doesn't work anymore. And I think we have to change from being saver to being an investor. If you had some experiences that you want to share in the last 2 weeks, anything you guys have been doing, anything interesting on your side?
Yeah, can I share with you, Vivek, and get your take on something that I've been doing lately?
Sure.
So I wholeheartedly agree with your vision or your understanding that the banking industry is not paying enough, right? So I'm not trying to endorse anybody, but recently I opened up, well, not recently, about a year and a half ago, I opened up an account with Betterment, one of those robo-advisors. There are many of them out there.
Yep.
And I'm realizing that it seems that the money is liquid enough and safe enough that I'm starting moving a lot of my money that I have in regular institutions into that Betterment vehicle, because I can always liquidify that money, but yet my interest, my ROI, my return on investment, is conservative, but it's higher than the bank, definitely. So yeah. I just wonder, what do you think about moving 100% away from the traditional banking to that model?
Sure. So Betterment, and there are other vehicles around similar for investing. And those, just for a little brief for background, there are companies that allow you to do robo investing. Betterment, Wealthfront were the leaders in it, in which you can basically move your money, and you can move it one time. Plus, also you can set up your profile saying what type of investor you are. You can choose the type of investments that you want to make, how much you want to put in on a growth stocks or value stocks. There are a bunch of options that are available in any of these robo-advisors. Now, what they do is, based on your risk profile, based on how you have selected your risk profile, they will automatically invest for you into those ETFs or funds, whatever is available. So for someone who is just getting into the market, into the investing space, I think that's a great way to go, because you don't have to really take an action to invest. They will automatically, you can set up the auto deduction from your bank account. They'll take money out of the bank account and invest it. Wealthfront is good. Betterment is good. But after seeing Wealthfront and Betterment attracting a lot of retail investors, the traditional brokerage firms have also started providing these robo-advisory abilities, right? Vanguard has one. So earlier, most of these big traditional brokerage firms had they did have these advisory services, but the threshold to get access to it, or threshold for entering or making use of that service, was really high. I haven't checked the latest numbers, but I do understand that the Vanguard, Fidelity, of the world, now they have their own robo-advisory services. And it's the threshold or the minimum investment to make use of that is not really high. So it is within the approach of common retail investors. Well, that's a good thing for us. I mean, these the fintechs company like Betterment, Wealthfront, they come and challenge these traditional advisors, and now those companies are responding. Let me just check. I think Wealthfront has total assets under management worth from $20 billion or something like that. Hold on. Oh no, 25. Yeah. So it's they do charge, some percentage like 0.25% for accounts over 5,000. But again, if you are an offhand investor, right, this is a great place to start. It's a number one, it is automatic. Most of the people, it's not that we don't want to invest. Most of the retail investors, they'll take a place that they would want to invest, but just that the inertia is so much that you don't want to go and take action every time. So if something is automated, that works out great. It's just like 401k, right? On this one, they'll take money out of your bank account, invest it in whatever funds you pick up to invest in. And the process becomes automatic. The process becomes periodic, right? It'll go out on a regular interval on the period that you choose. Now, I don't use any of these because I stay close to market. I don't want to give them 0.25%. But if they are not active, and this is a great way to start. And it becomes periodic investment, means then you're not really trying to time the market. I want to talk a little bit about the math behind timing the market little later in the section. But you get the advantage of dollar cost averaging. You continue to invest the same amount over a period of time. It's a great way to start building your nest egg. And like I said, there are others as well. Wealthfront is there, Betterment is there. I think a while ago I did an analysis of the various these robo-advisors. So there are multiple robo-advisors. Looks like NerdWallet has something that they are sharing, right? So SoFi has got, Vanguard has got. How about the Fidelity? I saw somewhere Fidelity also has that. Exos, Bloom, yeah. So pick anyone. The best way to pick one would be see what kind of investment opportunities are available. If there are ETFs, which are generally very low cost, and if you find a good mix of a different type of ETFs, say overall stock market ETF, growth ETF, value ETF, maybe bonds, maybe metals, depending on where you want to invest in, look at that. Then second thing is to look at is what's the fee that they are charging for managing this, right? And Betterment, Wealthfront, Vanguard, these are all Fidelity, all well-respected names. You can't go wrong by picking any of these. Just don't get into analysis paralysis and spend another year in trying to figure out which one I should pick up. Okay, but that's a great start. So thank you for sharing that. Samuel says, watching Baba go down. Yeah, all the Chinese stocks are still under pressure. And Baba, I'm also watching Baba go down. Not a happy situation to watch. Baba is in one of my, I think, my pizza as of last month. It was, if I recall, it was on top 10. So we'll see where I end up in Baba at the end of September. But I'm still holding on to it. We sell covered calls to reduce the cost basis. We'll figure out where these all Chinese, how much the crackdown on China, how long does it last? When does it get cleaned up? Again, don't invest too much into any one stock, or especially in the country risk like China. If it was more than 20%, 25%, I would start to lose sleep, but it's not a huge part of my portfolio. So it's still okay holding on to it. I must say, stayed out of China stocks. I haven't invested more, but I haven't gotten out of it. I mean, these are the stocks that I had held. I have Baba. I have three main from China: Baba, Neo, and the third one is IG. Right? Baba and IG are crashed. Neo is also down, but I've sold so much premium on Neo that I'm playing with the house money. So I don't bother much on the Neo side anyway. But we'll see. China also had other troubles. We're going to talk about the whole real estate stuff, which also impacted on the regular stock market. So we're going to talk about what's happened with Evergrande. And if that wasn't enough, China also came and rattled the crypto market a little bit. So too many things coming from China. All right, let's get into the macro stuff for today. This is how I would say the last week was. Monday, Tuesday, bad. Wednesday, Thursday, okay. Wednesday, Thursday was going good. And Friday, eventually, I think we ended the week from almost where we started. Not too big of a change. But that's why I always say, if to stay engaged, the price that we have to pay for the gains is this volatility. We will go up, markets will go up, will come down. We have to just make sure that we are invested in a good, solid companies, which will go through these ups and downs. They'll take it in their stride. Worst things have happened in the course, look at last 50 years. Much worse things have happened to the companies, to the countries. But our economy keep growing. The world economy keep growing. So from that perspective, companies will continue to generate wealth. And if we are invested in some of those good companies, we could be beneficiary. Just that we don't have to get scared and jump out of a roller coaster saying, oh, it's, I just can't bear that volatility. So, an interesting, I think this I saw on Twitter or somewhere, but this is what happens in the market. On Wall Street today, and suddenly, yes, many times you'll see CNBC stock and things like that. News of lower interest rates send the stock market up, but then the expectation that these low rates would be inflationary send the market down, until the realization that lower rates might stimulate the sluggish economy, push the markets up, before it ultimately went down on fears that an overheated economy would lead to reimposition of higher interest rates. I don't know, but all the anchors on this financial media have to justify always why the market has gone down today. And sometimes it's on hourly basis. Right? And if we want to justify, you'll get to hear this sort of a commentary. I consider all of these as a noise in the short term, unless the things are fundamentally changing. These day-to-day gyrations are just noise. As a retail investors, we don't have to justify to anyone, what's happening in the market today. And I do get questions on, hey, why the market has come down today? I don't know. I mean, there's something could have happened in China, something could have happened in Europe, someone would have said, someone in the Fed would have said something, and markets will suddenly react to it. Right? And I don't care on what happened today in the market. I want to focus on, as the companies that I'm investing in, have they changed their thesis? And in some cases, some companies have, and then I go and take corrective action on that. Right? I was very bullish on Jumia, and I talked about it earlier. It did great last year. And then I saw the management have changed how they want to tackle in the trajectory in which they want to take the company. They no longer want it to be a growth company. They want it to be a profitable company. Right? I thought, does it gel with my thesis on how I want that company to be? And take a corrective action based on that. Not based on that, not based on the stock has come down 15%. What should I do? But I'll take an action based on, hey, management is thinking to take company into this particular direction. Was that my investment thesis to begin with? If not, then let's look at what am I supposed to do with it. Otherwise, we will always be getting in and out, trying to figure out like a headless chicken where to move. The information is coming at us in such a fast pace and so much of information that if we start to react based on what's happening in the market, we'll just, I don't know how long even we can, survive that. Ralph asks, is there a recommended and a legal way to invest into foreign markets in countries like India, Germany, France? So I would think there are 2 ways. There are rather 3 ways to invest. Number 1, if your brokerage firm allows you to invest directly in foreign countries' exchanges and trade directly onto foreign country exchanges. I know Interactive Brokerage does provide some of that. Right? I don't have a personal experience though. Number 2 is to invest in the companies that are, say, in based out of India, Germany, France, or whatever foreign countries, but those shares are traded on US exchanges. Those are the ADRs of the foreign companies, right? For example, for India, I do trade on that. There are a lot of companies from India, based out of India, that are trading on US stock exchanges. Third way is to invest in a country-specific ETF. If you don't want to take a company-specific risk, or if you don't have a company-specific thesis, but if you want to invest in the country because you think that, say, India is a developing country, maybe it will grow, its economy will grow in next 20, 30 years. You want to take an exposure to India. There are ETFs, mostly coming from MSCI. There are country-specific ETFs that are available. We just bring up, see, for India, there is INDA. For there are others like EWZ is for Brazil. FXI is for China. I don't know France. I've never invested in France. Right? There one for EWJ is for Japan. And what's for Mexico? I'm missing that out. Anyway, so there are country-specific ETFs that you can invest in. RSX is for Russia. So that's another way. So, and then there is a fourth one. Sorry, not 3. There are fourth one is some of these shares might be trading in an OTC desk, over-the-counter desk. So the tickers would be, for example, T, right? They will have some F or T something at the end. So for example, this one, Equity Ads Holding, is a Chinese, it trades on Chinese stock exchange, but here it trades on an OTC desk. So these are also called pink sheets, but I don't want to use the name pink sheets because that's got a negative connotation. But there are OTC shares that trade in OTC desk, and if your exchange supports it, you can use that to invest. So hopefully that answers the question, but there are multiple ways to invest in it. Yeah, Samuel says, check out your brokerage or pink sheets. Yeah, that's, we talked about that. She wakes up every morning thinking about which company to share prosperity with. She's talk is cheap. I think there's some election coming up or some leadership summit coming up in China next year. So yeah, that politics is also involved. I mean, wherever there are governments, there will always be politics. Ramesh says, I buy EDR or ETF. Oh yeah, we just talked about it. Yeah, these are various ways in which someone interested in taking exposure to either a company from a foreign country, in that case it's EDR, or it is a pink sheet, OTC shares, or if you want a country specific, you got a ETFs available. Or the last one is trade directly on the foreign exchanges if your brokerage firm provides you with that ability. Okay. So what happened this week? Stocks flip-flopped, gains and losses throughout the week. We had some worries over China's Evergrande. I don't know however you pronounce it, Evergrande or Evergrande. We'll talk about it. And but that whole worries over this China's company prompted traders to pull $28.6 billion of US equity funds out in the first 3 days. And we don't know how much they put back in. So net, there wasn't big change or a week in this week. The tech stocks rallied on Friday. Oh, sorry, it trailed on Friday because of the crackdown on Bitcoin sentiment. So we would see some of those crypto economy stocks going down, Coinbase, some of the mining stocks, but financials did well. Why? Because the yields have gone up. I think the 10-year is now 10.46. It's still lower than where it was, I think, somewhere. This year actually we hit it, what, 10.7 earlier. Yeah, 1.76 in March. But this whole last week, there was a huge increase in the yields. That means that sounds good for financial sectors. So we did see financials doing well. Right? Another important thing that happened this week was a FOMC meeting, and the Fed came and told that we should expect tapering of asset buying from Fed in mid-2020. Till now, they've been buying $120 billion every month in treasuries and mortgage-backed securities. We should see Fed tapering down, stepping, away from it, and could see a possible rate hikes starting 2023. Some Fed governors say that, I think the committee is 18 people, 18 or 23, FOMC, whatever. I don't know the numbers, but it's a huge group. And some of those members say that probably this could happen even sooner. But any rate hikes will be good for financial sectors because that would mean we could see a increase in the interest rates, and that would increase their net income, net margin for the banks, etc. So we saw financial sector doing good this week on that news. Jobs growth number were not good. They were less than what was expected. And housing data was better than what we saw in previous month, but still well below their peak a year earlier. Yeah. Some positive news, some negative news. Overall, lot of ups and downs, but eventually nothing much changed in last 1 week. Right? This is called recency bias. Something that have happened very recently has too much impact on us. What happened last week? The markets went down in first 2 days. You're thinking, gosh, stock market is too risky. Right? Eventually nothing happened. I mean, 4 weeks, 5 weeks, we won't be even talking about, what happened to in this week. So overall, if you look at last 5 days, the overall S&P index is almost, up just by 0.5%. Again, not a big deal. Though the activities during that week might seem to us that the markets were on fire or going to the moon, net, nothing much has changed. Sector-wise, we did see some sectors recovering, like the energy was up 4.7%. But if you go back to 2 weeks earlier, our meeting, energy was the worst performing sector. So it is just catching up. Overall, not big of a change. So we don't have to worry about as a retail investors in trying to time this market. Right? A few tweets, the charts that I found interesting, thought I'll share is this one from Naval. Robots and computers will own any clearly bounded job, skill, or game. Humans should focus on creative work. Couldn't agree more than this. It all started with computers, right? The word computers came from because there were humans who used to compute, used to calculate things. So from calculate, they came to calculator. And then those humans used to do the computations manually using calculator and a register and a ledger. When those jobs were replaced by machines, those machines were we started to call those machines computer. That was 60 years ago. Things have become more and more technologically advanced. From doing just basic computations, now computers do a lot of other stuff. They'll run your accounting for you. So all those jobs or skills in which we can define the rules of if you receive an input X, this is how the output Y will look like. If there is any job which can be broken down into a series of a decision making based on what input you get, that's the output, all can be replaced by computers and the robots. The whole manufacturing industry has already been, most of it, the repetitive jobs have been replaced by robots. We thought that software engineering, it used to be creative work, but now we are seeing even the software engineering work is being replaced by AI modules. There's a lot of no-code, low-code platforms. The computers will generate the code for you. So computers are now doing more and more of a work that humans used to do. So humans should focus on creative work because there is no boundary around the creative work. If anything can be, any work can be defined by a set of rules, those rules will be run by computers one day or the other. The day is not far away. So I like this really, I like that quote. Next one, this I saw today, was the greatest trick the market plays on beginners is making you think luck is skill. It waits for you to double or triple down on your next bet, and then it teaches you your first lesson. And I'm sure whatever happened in 2020, not whatever happened in March 2020, but whatever has happened after March 2020 and next 6 months after March 2020 has taught or has probably fooled a lot of people into believing that we now know how the markets work. And I shouldn't say that it could be only for beginners, right? It's all about how you think about markets, and it's all about discipline. There could be many people who have been investing in the markets or trading in stock markets for years, but still have a tendency to behave like beginners, right? So it has nothing to do with how much, for how long have you been involved in markets. I think more of a mindset of a beginners. Anyone could have picked any kind of a stock in 2020 March. If you had given a dart to a monkey to throw it on an S&P 500 pie chart, and if you just bought those stocks, at the lower of, the lows of March 2020, that monkey would have made money, right? But that was luck. Let's not confuse that with our skills, right? And I think some of those stocks actually already taught those lessons. Those high-flying EV stocks, for some part of a time, it looked like that anything that has to do with EV is a great investment. Anything that is coming with the SPAC is gonna double our money. And I know, some made, but a lot of people learned the lessons the hard way. That was our luck. What happened in 2020, and I still say what happened in 2020 is not how the markets behave. If you made money in 2020, great. Happy for you. But don't think that we figured out how the markets work. That's not how the markets behave. That was a stroke of luck. I agree, Fed is still trying to think that it is 2020 and still trying to prop the markets up. Maybe we can enjoy the same ride for a year, maybe for another year. We are seeing like 2019 markets returned 30%. 2020, it returned 18%. And 2021, I think right now it's at 16%, 17%. I don't know what the latest number is. Maybe I have the chart, right? So it will be here. YTD, 18.62%. But we're not here only for 3 years. So understand how you prepare yourself when these situations won't remain any longer. Right? Have that understanding. That will make us as a better investor, is not to throw in money on every other shiny object which has worked in 2020 but may not work in, let's say, 2025. So idea is to learn. That was a luck and that wasn't our skill. So good thing, the better thing is to build a skill set to analyze the companies, analyze the businesses, and then learn how you want to take positions on it. Any opinion on FedEx? So FedEx is having short-term tailwinds because they can't find people.
I have an opinion.
Sure, go ahead.
FedEx sucks. When I was growing up in the 80s, we learned that FedEx is the best, on time.
Mm-hmm.
I've waited over 6 weeks to get FedEx stuff. And they are not a very I like UPS, even though they're union bought, but at least what I want from them, delivery, is done well. And FedEx is irresponsible.
So this is what we are seeing in the FedEx in the last few weeks, is because of all this labor shortage. And I was reading somewhere, I think their Portland or one of their
excuse me, they're not labor shortage. They pay less than Amazon.
Yeah.
If you want people, you have to pay.
Yeah. So the idea is this, right? Right now, one of their centers are running at 65% of what overall labor they need. Right? And so they can't even service well. And this is what is reflected also in the stock price and also in the experience that Samuel, you shared, is that they're not able to maintain the same level of service what they were able to maintain it earlier. Right? But if you ask me on the long-term basis on the FedEx, the fact that the e-commerce will continue to grow, the fact that the logistics as a business will continue to grow in a long-term basis, I'll be bullish on FedEx. Again, I have not done a deep dive on FedEx to understand at a company level, but they're in a sector which will continue to grow. And there are a few of the top players in that sector. So the stock price, based on what we saw in the earnings result, because of all these issues going on in FedEx, has been punished. Its all-time high was around 320. It's almost down, we would say 30% from all-time highs. But on a long-term basis, I don't think anything else have changed in the FedEx strategy. These are the headwinds that they will have to continue deal with, the issues on supply chains and etc. Long-term should still work good. Another interesting chart. This is one expense that we don't get to pay attention to when we're looking at any company reports is stock-based compensation. And what caught my eye was some of these big high flyers. Palantir pays 114%. Okay, stock-based compensation, let me just explain it a little bit, is the compensation that gets onto the books of a company. It's an expense, but it's a non-cash expense. This is where you award stock options to your employees. If you're working for a company, you got a stock option, you don't receive any cash from the company. Company doesn't have to dole out any money to you. So it's a non-cash expense. But it's still an expense for the company. So whenever you will see these companies reporting the results, they will generally talk about our adjusted earnings is so much percent. And when they talk about all these adjusted EBITDA, adjusted earnings, one of the big component that they'll take out from it is a stock-based compensation. And this is a pretty standard industry practice, right? But if the stock-based compensation goes through the roof, that should tell us something about that company. I was surprised to see the Palantir stock-based compensation is 114% of its revenue. There are two things. There could be two things to it. Number one is maybe they are not paying enough in cash as a cash salary and to retain those, and then they have to pay more in stock. I would say I'm not too much bothered about that if that's a real case. But again, I've not gone deep into these to figure out where each of the companies. The second thing is if they are paying salary, but they have to pay so much of a stock-based compensation to retain the employees, because otherwise they can move off to their, to competitors. It's not a great thing. So number two is the stock-based compensation means you are creating more stocks. We are to grant it to your employees, which means your overall pool or the overall number of shares is increased, and then it means your position is getting diluted. So this is at some point in time we have to start paying attention as an investor. Is my position getting diluted because now company is generating more and more stock because they have to pay too much to their employees as a stock-based compensation? So on an average in a SaaS, I think this was from a SaaS industry, on an average is around 20%, close to 20%. Now, I think this is probably median, not an average. This looks like a median is close to 20%, right? But Palantir 114%. Snowflake is 68%, Quarter is 65%, right? At the lower end are Appians and the Shopify and Adobe. So this was an eye-opener for me in terms of looking at how much these companies are, I would say, diluting the existing shareholders because they have to continue to pay too much to their employees just to retain them. Steve says SBC is a great way to rip investors off. Yeah, in terms of a dilution, right? Suddenly now I own a even smaller portion of the company. Where do you get this information? If you really want to focus on SaaS companies, Well, let me just bring up that person on Twitter. He is from Altimeter, Jamin Ball. He puts some wonderful stats on all the SaaS companies. If you really are interested in following on the SaaS company, follow this person. He's not related to me. He's not my friend. I don't know him. I'll be glad if he, just like one of my tweets. But again, he always focus on SaaS. He'll share multiple different stats on a lot of SaaS companies. And I do bring some of his charts and the values and tables in this meeting. But that was my source of information. Steve said, my company included. My company is not even listed here. We are a startup, not even an IPO. Palantir stock composition to keep the skilled employee. It's very in-depth specialized skill. It is possible because Palantir is doing something which looks to be some secret magic, and maybe very specialized work, like Zifty says, that other companies can't do it, and that's why the governments and the organization on the government bodies across the world make use of Palantir software. But again, it's a good to know in terms of how much they are paying, so that we understand as a investor how much dilution is happening for us. Another interesting chart, S&P 500 5-year CAPE adjusted earnings yield. This talks about your earnings of an S&P, right? Right now, we are looking at the bottom of those earnings yield. And again, history may not repeat, but it may rhyme. So be careful in terms of when you're dealing in stock market. Is markets go up, markets come down, doesn't mean that it doesn't. Let me tell you one thing. It doesn't tell us anything what's going to happen after that, right? But it's good to know how the markets are valued at current level. Things are a little different from what it was, let's say 10 years, 20 years ago. But it's good to get this perspective in terms of what's our cyclically adjusted earnings yield of the S&P is. Right now it's at the bottom. That means we are paying too much in terms of valuation for the companies that we are owning, or the market is, from a valuation perspective, market is really high. Could that continue? It has continued for last few years. Could it continue further? Maybe. If we continue to have a zero interest rates, if we continue to have a Fed supporting, and Fed not just US, but let me use a generic term, central banks across the world supporting the market, this party could continue. But if not, things could come back. So good to be aware of it. All right, other one is, what is Dry Baltic Index telling us? This is the index that I never paid attention to, but came across. It just reached its highest level in 12 years. So the Dry Baltic, do I have this definition? Oh, no. So let me just pull up what does the Dry Baltic Index is. This basically tells about the shipping cost. How much does it take to ship goods? What does it tell us? It's an average prices paid for transport of dry bulk materials across more than 20 routes. So based on what we've been seeing in the shipping rates, it's no surprise that the Dry Baltics Index is now hit highest in its 12 years. That means the cost of transporting goods has become highest. That means those goods becoming highest means more inflation in the economy. That means central banks will have to wake up and try to do something about it. Is it transitory, as the Fed has been saying for a few months? May not be transitory. Some portion of these inflation will never be transitory. But this is not a great picture. So we did get some feelers from Fed in terms of increase in interest rate and easing of a bond mortgage bonds buying back and the treasury buying back program. Let's see how it makes a change. And not just the index, right? The companies are taking notice. Last month, 197 S&P 500 companies use the term inflation. The prior record was 163, almost 11 years ago. Almost kind of a consistent with what we are seeing here. 11, 12 years ago, we had the highest, the dry index was highest. Companies and economists talking about inflation. And that's where we had most of the companies talking about inflation in 2010. And now we are seeing a similar situation. That means if the inflation continues to go high, the money sitting on our bank is our own enemy. Go back to our first quote of the week, right? Start investing if this situation, or start owning the assets. Otherwise, we'll be just losing our purchasing power. So I was surprised and I would say more angry when I saw Gary Gensler advocating saving. I mean, I think his intent was good, but the choice of words was not. He basically talked about how, folks in college should start saving sooner and, to build their nest egg. My only peeve here is don't just start saving early. Just start investing early and invest regularly. For whatever reason, when you talk about saving, it's the savings account, is the CDs. It's like, hey, let's put the money in the bank. That's your call to action when someone talks about saving. But if you do saving now, basically we'll be losing tons of money, not in terms of a purchasing power. So I was really surprised. And then I saw crypto Twitter jumping onto it, saying 100 millionaire. He made a lot of money when he was with Goldman Sachs, right? Telling kids taking on 50K in debt, getting an education to save $5 a week in a high inflation, low interest rate environment, while running the agency that prevents them from investing in high upside potential investment. Really, that sums it up. So instead of start savings, I would say start investing. Zifty says, I just wish Wall Street bet pump does not make the stock volatile. So my opinion does not relate to short-term price because WSBs are short-term trading. And the WSB is not able to, pump the prices for all the companies. They are able to pump up the prices wherein, and sometimes I feel probably those are the companies in which we shouldn't be investing anyways. Either the float is low, or the companies are already on the death list. They're just trying to pop it up based on sentiment or whatnot. Haven't been able to touch the some good and great companies that trade on our stock markets. Can't do anything with Facebook. They can't move Apple. They can't move S&P 500 ETF. Forget about companies. As an investor, ETFs are also a great vehicle to make wealth. WSB, may not be able to uh, uh, impact some of those big companies. But yeah, small company, those are the good gambles to take on. Those are the lottery tickets, or depending on, is a lottery ticket or a ticket to destruction, depending on where you got into, whether was it before the pump or after the pump. But yeah, now that I think markets are now understood, market doesn't react too much to what's happening. The overall market doesn't react too much to what's happening on the WSB. Of course, the individual stocks could go up and down. So, all right, let's move on to what we saw on Evergrande. The reason I want to talk a little bit about this is it did have an impact on an overall stock market, not just the stock market, even on the crypto market as well. And I don't think we are completely out of the woods just yet. So the markets, based on what we saw in markets on Thursday and Friday, it suddenly thinks that, oh, everything is back to normal. As far as Evergrande is gone, I don't think it is back to normal. So let's took history around, what this is and why it has become, a factor that has started to impact and actually impacted some of our stock markets, right? And the markets across the world as well. So what is China's Evergrande? It's an heavily indebted private sector property developer and home builder. Sounds familiar? 2008? Maybe we didn't have a single developer to whom we can pinpoint, but it's the same story. Highly indebted developer have taken on billions of dollars in debt. And if they don't repay their debt, could be in default. So the most urgent deadline was September 23rd, and they haven't paid on their dollar-denominated bonds. They had $83.5 million interest payment due, on which they have defaulted. But they still got 30 days to pay before the company is technically called a defaulter. So they haven't paid it yet, but they got 30 days to figure out. Now, on a yuan denominated bonds, they told that they will be able to pay. Right? So the issue is with the dollar denominated bonds, which they missed out the payment date. So they still got 30 days to do it. But hey, why are we worried about one company not able to pay their debt? And what's the big deal? Companies go bankrupt all the time, right? So let's see, we'll talk about that, but let's see what is China government. I think the rest of the world is thinking that the government will step in, because this is it's a big company. They are in 200 cities. So Chinese government just can't let it default. Right? But as of last week, China government has not done anything. CCP hasn't done anything. Rather, they've told the local governments to get ready for the possible storm. They've tasked the local governments to make sure that they have enough police to prevent unrest and mitigating the ripple effects on home buyers and broader economy. They're not going to, as of last week, Chinese government hasn't come back and told we will save Evergrande. Right? It signals its reluctance to bail out the debt-settled property developer. Could it change in the last moment? Possible. There are precedents for similar behavior. Some other companies in the past were bailed out by China in the last moment. But this time the situation could be different based on what we have seen in last few months on the crackdown by Chinese government on private companies. It does send a signal that government is not focused on saving companies, but they are focused on reducing the impact onto the Chinese citizen or Chinese population. So that will be their focus. So if they were not able to pay the yuan denominated bonds, maybe China would have, Chinese government could have stepped in, but those bonds have been bought by the investors. Right? And I see Steve mentioning BlackRock bought a lot of Evergrande loans. Yeah, not just BlackRock. There could be other investors who would have bought Evergrande bonds on the loans. Chinese government is in no mood to save them. Right? So we'll see what happens. I think right now they're focused on the next year's summit or elections, however it goes over there. And President Xi Jinping has to make sure still stays popular.
I disagree with you. Business, how stuff is done in China is really screwy, and the government doesn't want like it says right here, snowball into other concerns, because everything is not really done on the up and up.
Yeah, so I mean, the government will make sure that it doesn't snowball into the concerns for the local citizens, and but they will not going to do anything if it impacts the, let's say, the investors that have bought these companies' bonds, right? So that's all I was trying to say is they may just let the company default on their international bonds. That would mean that the image of Chinese companies and China as a whole as an investment destination will be tarnished. We've already seen it in the last 3-4 months, what's been happening to Baba and other companies that China has been targeting, but they doesn't seem to be bothered by that. I mean, CCP wants to have that control. If that means that China no longer remains a destination for investment, maybe that's a path that they want to take to. So markets think that eventually it will be bailed out. All I'm saying is that is not a certainty based on whatever we have seen Chinese government doing in last few months. So they got a $78 billion in revenue. They got projects in more than 200 Chinese cities, but most of them is all borrowed money, right? You pay upfront for your apartment, and then the builder will basically start constructing those apartments. And that game has worked out really well for years. I mean, that's the modus operandi of many of these developers is, right? But because of the property lockdown, there were no sales for months last year, and they had a huge cash crunch. Not only this, the China also started to crack down on the huge leverage by real estate developers. So that's how it suddenly, Evergrande got into trouble. Otherwise, this was like you borrow money and you get your prepayment for all the apartments, and they build apartments, you sell it, and you keep moving that whole cycle of operating on leveraged money. The cycle was broken by the pandemic and the Chinese government limits called as 3 red lines. So I actually try to dig deeper. What is the 3 red lines? So these are the limits that the Chinese government set on how much any property developer can take liabilities to total assets ratio, net debt to equity ratio, and cash to support short-term debt. So cash to short-term debt ratio. So these 3 ratios, the government has put a limit that you cannot have more liabilities when as compared to total assets. They put a limit onto that. So Evergrande couldn't borrow more. If they can't borrow, and the customers are not buying apartments because of the pandemic was locked down, how do they pay their suppliers? How do they pay their contractors? How do they pay their lenders? So this, in fact, they ran into problems, so much cash crunch, they just started paying suppliers with the unfinished apartments. So no money available. Take an apartment which is unfinished, pass the rights over to them, which we don't know whether they will ever be finished or not. We don't know whether the company will be able to construct and come through all its obligations or not. $78 billion revenue, $88 billion debt at end of June. And they got 1.4 million apartments worth $200 billion. So overall, if you look at close to $300 billion of liabilities. These are the liabilities of the around the unsold apartment, not unsold, but this is called unbuilt, yet to be built apartments, and $88 billion is the cash liability, is their outstanding debt. So the bigger question is, could it cause a financial crisis? We've already, I think Steve mentioned, BlackRock holds a big chunk of Evergrande loans. So if there are other financial institutions, they will have to write down the value of these loans on their books. So suddenly we could see, and we have no idea in terms of who is holding what, but the possibility is what happened with Lehman Brothers. All those bonds, Lehman Brothers had to fold up because they were holding all those exotic Wall Street created those assets, those collateralized assets, which became worthless. Right? If these bonds become worthless, what happened to the companies? Those are holding those bonds in their books. Suddenly, they will also be in trouble depending on how much they are holding. That's one. Number two is the investors may run away from the other developers, right? Not only Evergrande, but the default could spread to other developers. And then on the other Chinese consumers who are buying properties, so this could have a wider impact than just one company. And then that's what spooked markets on Monday and Tuesday. But maybe we figured out that not many companies across the world actually hold Evergrande's debt. So this may be just contained within China. In that case, it's better than, across the world phenomena, but still could be bad for companies that derive the big revenue from China, right? Like Starbucks, Nike, Apple. If it hurts the Chinese economy because of the repercussions within China, and let's say if Evergrande goes bust, other property developers goes bust, it's not just one company. There's a whole ecosystem that will be around it. The contractors who work with those companies, the building materials companies that supply materials to these, right? There will be a cascade in the chain of companies that could be in trouble. So that's why we saw what happened in the market. But right now, Chinese government is not talking much whether they're gonna bail this company out or not. They could. Till now, they haven't said anything about it. Steve, could be a great time to buy Chinese stocks, a penny for $1. Right now, I think, I don't know if you're talking about the property stocks, there's a risk, but then that's where the huge reward lies. What if Chinese government decides not to bail this company out? Then the stocks will go to zero. But if they decide to bail this company out, suddenly we could, call ourselves genius. So it's come with that risk profile, right? So if you don't mind that risk profile, go ahead and take your chances with it. As if they say, like a penny stock investment, comes with a huge risk. Yeah, exactly. I do hope that they surprise me, though, to be seen watching from the sideline. I think that's what the world is hoping, that Chinese government may bail them out. but the government hasn't given any indication till now.
I got a question. Do you know of how screwy your government or how your business was done in India?
So with respect to what?
No, well, I mean, I forgot about all the screwy stuff in mainland China because I was in Hong Kong for a year. But like I said, the way things are, I didn't buy any Chinese. I only had $800 in Chinese stock before April of this year. Now I have about $35,000. I forgot how screwy stuff is done in China. And do you know much about how screwy, how undocumented stuff are done in India?
So there are even in I think all these countries which don't have a well-established capital markets and not very transparent governments, there are always these challenges around companies and the governments, governments favoring some of these companies. So of course, there are stories out of India, and we know some companies out of India which have gotten huge favors from the government. And the hand in glove with the government, you can bribe some officials and get some ruling in favor of in terms of for example your decisions about foreign direct investments in India, right? For years, the big companies, the incumbent, I would say, industrial houses in India have been paying the government bureaucracy to not allow foreign investment or foreign competition. It succeeded for decades, but then the government started to open up. But has it become completely transparent? I would say no. Just like any government, I mean, even on the US side, right, there is a lot of lobbying happening, a little more transparent in US. It is not transparent in India. You don't know if the new regulation has come in, who is lobbied behind it. Probably that has been lobbied and paid for by an industrial house. We may not know. US, the same thing happens, just that, but there is little more openness and transparency around who is paying what. But at the end of the day, the governments, both US, there's some shady work that happens across every type of a country. Just that how much happens, the extent is different. So I'm certain there are some great companies that have also come out of India, have changed the business practices, have instituted, paying like stock options, giving stock options to employees was never a thing. It all started when Infosys listed in US, and everyone, suddenly in that company became millionaire from an Indian currency perspective. The rest of the company started to pay attention. What is this new way of paying employees, and why all the good employees are going to one particular company? So there are good and bad company examples, I guess, across every country. But yeah,
well,
it's not as transparent as in US. I think Zifri said they can afford to lose that bet. I think it's about BlackRock. It depends on how much does a BlackRock has. Right. All right, so the other one I want to talk about is a risk. What's happening in the markets from the risk perspective. And two things is risk taking versus risk seeking. And it is, I think, becoming more and more important now. This is an interesting chart I saw. Is from being a risk averse to the risk seeking. The question is, where do you think you lie on this spectrum? Completely risk averse or risk taker, risk tolerant risk taker, or risk seeker? Where it's important for us to understand the difference between different risk spectrum when we are investing in stock market. Bull markets give and they take away. One of the most valuable assets that has been erased by this bull market is a difference between risk taking and risk seeking. And again, this ties back to what we saw in 2020. Based on what happened in 2020, are we becoming a risk seeker instead of a risk taker? You can't invest at all without taking any risk. If there is no risk, there is no reward. Even if you keep money in a treasury bills or in a bank, the risk is that you're losing your purchasing power. Right? I'm not going to read word by word, but let's have a little more discussion at a high level on this one. But there is so that's the inflation, that's an involuntary risk which we cannot avoid. But a long bull market that we have seen for last many years have pushing or goaded many investors taking voluntary risk. So Ramesh says risk taker, not looking for trouble. Yeah, I'm a risk taker as well. If you're not a risk taker, you cannot be in the stock market. Period. We had to take that risk to make the returns. But over the last 10, 11 years, the bull market might have pushed many of us into taking the voluntary risk to become a risk seeker. So this article came in Wall Street Journal. So they talk about how one retired accountant in 2020, started becoming day trader and made some money, and that just became like a sugar rush. At the end of the day, looks like says made around $18,000 in profit. But if I just parked money in some index funds, I'll be probably a lot more up than I am. It's not such a good way to invest, maybe, trying to time the market on a daily basis, but it has kind of become my life. I think these are the more important words. I have some friends who they trade on daily basis, who try to time the market, and I'm still friends with them, even though I don't like that style of investing. But the question that I have is, if you're one of them, are you doing it because you think there's an advantage, or because that has become a way of your life? I have nothing else to do, and it gives me sugar rush to get in and out, thinking that I've nailed the bottom and bought it, and then figured out the top, and then I'm selling it. S&P 500 has closed all-time highs 54 times this year, which makes us think that the markets will never go down. And when the environment seems to become safe, that the markets will never go down, people will take more and more risk. Right? And Federal Reserve, central banks have made it less riskier. It made it appear less riskier than it actually might be. So when the times looks great, I think that's the time when we have to be most cautious, which is now. The recovery from a COVID crash has reinforced the sense that markets are safer now. So ask, is this a risk I need to take? And secondly, is this a risk that you understand? We have seen many stories of people losing their shirt and then their accounts because they took a risk that they don't understand. Eventually, you have to take risks, but you don't have to actively seek them. I think that's a different section we want to make. Is if you're trying to go and say, I want to invest in the latest biotech company, are you a risk taker or a risk seeker? That's where the differentiation lies. I want to invest in a stock market because it looks like over a long period of time, stock market goes up, but it could go down and stay down for next 3 years. If that's our line of understanding, Are we risk seeker or risk taker? So there is a difference between these two examples. So understand which side of the spectrum do you like. And you don't really have to jump in front of a car, right? Don't have to go ahead and seek risk if you can, stay without it. So that's the gist of this article. And eventually then I also looked at, I dug deeper into the whole market timing stuff. And it looks like there was a report. It is probably a year-old or 2-year-old report. Is if you had invested since January 3, 2000. So this talks about, does the market timing really works or not? And I would say probably it would work, provided, right? Now we'll get into what does that provided mean, right? It's the same question. Does the buying lottery works? Yeah, it works for some, provided you can figure out what the numbers would be or can guess what the numbers would be. You're going to make tons of wealth. So there was a study done on looking at starting 2000. If you have taken a bunch of money and invested in S&P 500, right? We are not even talking about trying to invest in individual stocks, etc. Let's, for the base, use S&P 500 as our base. And like I said, this study maybe a year or 2-year-old. So whatever, till that time, your $10,000 would have given you annualized performance of 6.06%. But if you miss the 10 best days because market was up, I sold my positions, I will go back when the market comes down, right? I'm trying to do the best for my portfolio. We all want to sell high and buy low. But if you just missed those 10 days, I think out of which was what, 1,500 days. If you miss just 10 days, your performance would have gone down to 2.44%. Miss 20 best days, you're neutral. Right? And then we complain, I've been trading, hey, we're in the market for a long time, but doesn't seem to be working out for us. Because I missed those 20 best days. There were 20 best days that I missed out because I took my money off the market and thought I'll get back in the market at an opportune time. Maybe on those 20 best days, I don't know, maybe I was busy, maybe I was partying, maybe I felt sick. I didn't get back into the market on that particular day. And out of those 1,500 days, 20 days is not a big thing, right? If you miss those 20 days and you were not in the market for 20 days, your portfolio would have been done nothing. So you get the gist. And we missed 30 best days is 1.95%. That's the reason why I'm still holding on to some of the stocks that have gone down, trying to reduce the cost basis. But this whole market timing, the math just doesn't work out. Especially if you're a retail investor.
I don't really agree with this 20-day, 30-day. I heard that 25, 30 years ago. I mean, look at where Apple has gone. It just keeps on going up. Amazon goes up. NVIDIA goes up. I mean, you just hold it and let it alone. I mean, maybe it's the S&P, but I don't really believe that. That's what they were saying 25 years ago or 30 years ago.
So we're talking here about S&P. Let's say Apple, right? I don't have a chart for Apple. There
Apple,
is on Apple or NVIDIA. The whole idea, I completely agree with you. Those companies have gone up. But let's say if you try to time the Apple, when Apple went up to 140, 50, you would have sold. And then, saying, okay, I'll buy back when it goes down. And you never bought it. If Apple goes up, you don't make that money, right? There are people who sold Amazon when it fell down from $90 to some $20. And I heard those people come and talk about it saying, I sold Amazon, thought I'll buy, buy it again later. But there are two decisions. You just get your inertia that it becomes difficult to go back and buy it and track it that I sold it then. And that's exactly what I'm saying. In the S&P, if you have not bought back and didn't have when those 20 best days appear, your portfolio would have done nothing for you.
Can I give you an instance? My mom said, don't do market timing.
That's exactly what I'm saying. Don't do market timing. It doesn't work.
But I bought HP when it was going up at 40 back in 2006. I have barely recovered the money I got back because they fired Mark Hurd.
So because you didn't pick, so the idea is look at the good companies.
Well, it was a big company.
Big business, look at the businesses and focus on how the business is doing and not focus on how the stock price is doing.
So like I said, I barely recover.
So because the HP hasn't been doing good as a business, right? But
that's because they fired Mark Hurd.
Whatever the reason, right? It's a company's business. So if I look at, say, Amazon, Amazon hasn't done anything over the last 1 year. Should I still sell it? I'm not selling it because I'm still holding it because I like the company as a business. So that's why I want to focus on business. HP, if you focus on the stock price at 40, but the business wasn't doing good, the management wasn't good, that was the reason to get out, right? Neo had fallen from 60 to 40. I'm not selling out of it. I mean, I didn't sell out when I actually started getting into Neo $3, $5. Imagine if I had sold it out at $20, I would have made 4 times of my initial investment, right? And then you never get back. Me trying to time the market, and now it's about $40. That's where we use options to reduce the cost basis and be still in the market and get hurt less. I just hate market timing. Just doesn't work out for me. But I do have a lot of friends, do know people who try to time the market. Good if it works out for them. Just make sure that we compare it with what the general market has done. Too much for me, it seems to be too much of a work in trying to get in and out. Rather use that time to analyze great companies and good businesses, and then use options to reduce the risk rather than getting out of it to reduce the risk, thinking that you'll get back into it again later. So that was an interesting read on market timing. So be aware what we are getting into. I haven't been great into from a timing perspective, but numbers doesn't look to be in favor. Unless you're institutional investors, you're trying to live through quarter by quarter because you have to project quarter by quarter profits. And I don't see any reason why we should be trying to time the markets. That's all about the stock markets. Has anyone done the reverse of missing out the worst days? Good question. Maybe I'll go and try to find out. The reverse of missing out one days means you bought on those 10 best days. That's a great question. I don't know. I haven't at least seen any institution doing it. But it's exciting. I mean, selling and buying is exciting. Don't get me wrong. I've been a victim of it myself. It feels good when you're able to sell it and the markets go and the stock goes down. Makes me feel genius. But then I realize on a long-term basis that because then I forget about that stock, and then I realize that stock has actually doubled or tripled from where I sold it. And I say, that wasn't really the best decision, right? So I see another one. I did my own experiment for Tesla, another sell and buy back cheaper, and it has not worked out so far. Okay, that's okay. So thanks for sharing, Zifty. I mean, I had tried to do it earlier, didn't work out for me. If you have a good business, if you like that business, hold it. We don't have to jump out of a window and say, oh, the market is down 2%, my stock is down 10%. I'll get out and I'll buy it back once it's down further 15%. Just may not work out in a long term. All right, moving on to a quick overview of what I saw on the crypto side of the house. We'll not get into the details, but a quick overview. Regulatory actions coming from China. They banned Bitcoin maybe 10th time. China keeps doing these things over and over again. But more importantly, so I'm not bothered about this one. I think Bitcoin fell down 5%, 6%, whatever, on this news, now back up. But more importantly is regulations coming on US, which I feel it is good. Today's news, today's or yesterday's, was that regulators are now looking very closely at the stable coins and to regulate the companies that offer stable coins. I mean, that's one of the best news I've heard in a long time. Positive news coming from regulator on the crypto side. It will cause some short-term pain and short-term volatility because the companies that have issued these stable coins, if they are not well capitalized, they will have to stop doing business, which means we'll see suddenly liquidity moving out and some crash. Long-term, great news. And the third one is, again, this is what I think I hate when not a good news is Celsius, which actually can give you 8% return, is now receiving cease and desist order from some of the state regulators. Why? Do you want me to put my money in your bank account to get 0.01%? Come on, let me live with 8%. Let me take my own decision of where I want to put money. Okay. But this one, not a positive news. First one, neutral. Second one, I consider positive. This one, not positive. But we still have to see what happens. That was on the regulation side. Corporate side, Twitter. So we should keep an eye on Twitter. Twitter have integrated the Bitcoin Lightning payment network into the tips feature. So Twitter had introduced tips jar feature we talked about a few months ago, in which you can actually tip someone for their contributions that they're making. This week, Twitter announced, earlier they had announced that they will start accepting Bitcoin for it. And now they have integrated the Lightning network for Bitcoin payments within the Twitter itself. Right? Now we can imagine if I want to tip someone, say in Europe, right from Twitter, I can do that in a couple of seconds. Don't have to worry about foreign exchange, charges, no remittances, nothing. You can do it immediately through Twitter. That got me thinking, what happens could this become a gateway for remitting money back to the home country? Say I get my brother onto Twitter, and if I want to remit to remit money in the home country, I pay through Twitter's Lightning network. and my brother can convert it into whatever currency he wants to convert it into. So no the volatility risk because it happens under in a few seconds. And just that we are using this network to do a quick transaction. I sell my USD, buy Bitcoin, use Twitter to transfer it, and there the family can convert it into the currency that they want to use. Why would someone need Western Union in that case? So no surprises. Western Union came up with the statements saying we are spending $250 million to do some digital innovation and whatnot, because now they suddenly see threatened by all these new age companies. Robinhood will be rolling out a Twitter crypto wallet. Today they don't have it. Today, if you trade crypto on Robinhood, you can only sell it at Robinhood. But now they have laid out a plan in which they will allow the holders of the crypto assets to move or to transfer those assets out of Robinhood wallets into your own personal wallet. I don't want to leave my stuff at Robinhood. I bought it. I want to keep it with me. Now Robinhood will allow. They have showed a plan. I think maybe early 2020 is when they will. 2022 is when they will have that capability. And third one, corporate side, investments keep flowing in this market. We saw another $250 million of funding round for Dapper Labs, which is into creating NFTs, NBA Top Shots, CryptoKitties, at a valuation on $7.6 billion. So the venture money keeps flowing in this side of the economy. We also saw long-term investments with little spending behavior. They continue to sit tight. 93% of the supply hasn't moved in a month. Despite all what we are seeing happening in Bitcoin going up or down, 93% of supply just sitting tight. And miners spending more money to get their equipments to strengthen the Bitcoin network. So the hash rates continue to grow. What else? More scaling solutions coming up. Again, Bitcoin is one network. Ethereum is for smart contracts. Currently, it's been bogged down by the slow speed because there's so much demand. It's you can only you have only so much width on your highway, more and more cars coming in. The traffic grinds to a halt. That's what's happening with Ethereum. You have to transact or do anything on Ethereum. You have to pay a lot of fee, just like our expressway. So a lot of work happening to scale it. So another one's with the name Scale coming up. I mean, the three already. Polygon has been used. Arbitrum recently launched. Optimism still working. Scale is a new one. Lastly, on the Korea news from Korea, I should have put it under the regulations, but I forgot, is the authority in Korea had asked all the exchanges or all the companies dealing in digital assets or crypto assets to register with them. And they had some preconditions, what the conditions you need to meet for getting the registration done. So only by 23rd of September, only 10 exchanges were able to meet that deadline. 18 more were working towards it, but I didn't see. I was trying to search today morning, out of 18, how many of them were able to meet the deadline of 24th. So this could bring some volatility, because I think there were almost close to 40 exchanges in Korea operating and allowing people to engage and trade in digital assets. Looks like only 10 of them were able to meet the regulatory requirements. So the remaining, if these 18s also were not able to meet, the remainings will have to cease operations. So might see some volatility because of that. Lastly, okay, so a little bit on the DeFi side. The interest in DeFi is still holding up. That's what we also saw. The Ethereum continues to become more and more expensive, and close to $167 billion is logged under all the Ethereum smart contracts that are engaged in lending, in borrowing, in staking, in getting yield, all those sort of financial transactions that we as an investor would want to engage in. So $167 billion. Which bank would not want to have this piece? Everyone. It's a huge total value locked under Ethereum. This is just the Ethereum DeFi ecosystem. I don't know how much in the Solanas and the others, but it's a great example of a decentralized. No one controls this, and it's just run as a protocol and got $167 billion worth of assets logged into it. That's all serious stuff. Some fun. Netflix is releasing a documentary. I thought they already released it. So yesterday night I was searching for it, and then I realized, oh, it will be coming. Trust no one. The hunt for the crypto king. So this is the story. This will be the, I don't know, again, so based on a true story of a CEO of Quadriga CX, is a CEO of a Canadian, this is a Canadian exchange. Her name was Jerry Cotton. He presumably died in a foreign country. Only thing we came to know later on that this crypto exchange had $250 million logged into a vault, into a, let's say, wallet, and only the CEO had the key to the wallet. Now it's done. It's like someone had the gold, and then he, he hit the gold somewhere in the ground, somewhere, and then that person died. And now no one is able to retrieve that money. So there's Netflix is coming with a documentary. I think it will be released in a premieres in 2022, because the backers of this exchange or the investors, they don't believe that the CEO actually died. They believe that the CEO actually faked the death and has basically has got a private key, and they ran away with the money. So we'll see. So the investors hired forensics, crypto forensics and sleuths to figure out what's happening. So Netflix is coming with a documentary. I'll be watching it. Seems to be pretty interesting. So that's it for today. Last section will come on to is the review of some of the option trades. Well, let me look at some of the questions. Zift is a sideline for Chinese stocks for now. For me, even if it quadruples, I have no regret. Do what you feel peace, not according to other people's appetite. I could have said any better, Zifty. Thank you for that line. Do what you feel at peace. Don't do anything which makes you lose your sleep. Doesn't matter if your friend has 10x his money in an crypto or in an EV firm. If investing in that crypto or EV stock would have caused you to lose your sleep, it's not worth it. Really not worth it. So from a Chinese stock perspective, if you think its risk is too big, you don't want to invest, you don't have to. There are so many opportunities outside Chinese stocks, right? Within the US stocks, there are so many opportunities. Why you have to wait for, you have to take that risk if you, again, you're a risk taker. Don't go ahead and seek your risk in China. No one is forcing us to buy Chinese stocks. So if I'm not okay with that risk, we'll ignore it. I am personally not adding more onto my Chinese portfolio, but I'm not thrown away or sold the Chinese portfolio that I hold. We have options, so been reducing the cost basis. Again, that I did an investment, I invested it for next 15, 20 years. So I will still see where those stocks end up. Zifty says CEO died, so everybody accounts cold storage are locked because, and that's how stupid this was, and that is why no one believes that CEO actually died. They didn't have a multi-sig wallet, which is, I think, for any institution, first thing they'll ask, they'll always have multi-sig wallet so that they are not dependent on one person. And then they will have those logic that out of 5, at least 3 keys need to be turned in, right? Just like your, just imagine that your safe deposit box. So multi-sig wallets are like that. You need to have, more than one key, sometimes 5 out of 3. There are different logic you can implement, but looks like the claim is that CEO died. Many people don't believe he died, because he also died in a foreign country, and they produce a the death certificate from a doctor in that foreign country, and they don't believe that it was actually, it's not a fake death certificate. So yeah, maybe if you want to know more before this Netflix documentary comes out, go and try to search for Quadriga CX saga. You will find more. How can a private key for that entire exchange be held by one person? So I think this exchange was came into being during the early part of this whole crypto economy. And I don't know whether the whole exchange or maybe where the investor funds were. The wallet in which the investors fund were deposited, investors' assets were deposited, was that the key was only with the CEO. So again, I haven't done my own deep dive into this. I'll wait for Netflix documentary to see what really happened, but it did come up in the news when there was a news, the actual news flash saying the Quadriga's CEO has died, and this 200 and there are 100 of millions of dollars now are kind of locked in a wallet which no one can now take it out. All right, so SP had shared missing the 10 best days and other propaganda. Oh, cool. This is a myth. So good. We should read through this as well. Okay, this is a big one. So let me go through this. Maybe we'll talk about this in the next section. Is 10,000 growth. So indicated missed 10 best days. It will be this. Okay. All right. So let me read through it. We'll bring it. This is the beauty of this community, right? And I like this when we get a different viewpoint than what I found it. It helps us to look at the overall. So thank you, SP, for sharing this. I'll go through it and then we'll talk about it in our next meeting. See, we got some other some different information. So thank you. Lastly, on the option trades. Okay, so yeah, so I need to read through that document. Option trades, some reviews. Total 3 trades we closed this week. All 3 were profitable. New trades 9 we opened. No surprises. Why I was more active this week than the other weeks? Any guesses? Want to take a rough guess why? Like last week, I think I opened, not last, we made it previous to previous week. opened about 1 or 2 trades that I shared. This higher IV, Cedric got it exactly, hit the nail on the head, volatility. We got a decent spike involved. And I'm like, okay, that's the time. That's why we hold, cash on the sidelines, wait for the market to provide us with these opportunities. So I became a little more active and started building our November portfolio. So opened 9 new trades. So let's look at the trades that we had talked about in the previous session and how much of them is still open, how much of them is still closed. And I'll share one more trade for this meetup. So last time when we met, we had XBI that was open. So it was an iron condor, well-defined risk, nothing fancy out here. It was, I think it short strike closer to expected move. So from expected move perspective, it was well within our risk parameters. Only intent was to just harness some premium. And then we had a CrowdStrike, and then I had an EEM. So out of these 3, it closed XBI, got auto closed at the profit target. That's the beauty of putting GTC order. You don't have to monitor it. I have a profit target. All I hear, if I'm logged onto my phone or on my tablet while I'm working, and all I hear is a ding, ding, and then okay, something happened. Some trade would have automatically got closed. So no management, nothing else. Stock actually went down since we opened it almost 1%, but it was a $10 wide iron condor, and we profited 230. So 2 contracts. So 11.5%, decent ROI. I will take it 11.5% for 20 days anytime. I don't have to really wait for those EV stocks or those biotech stocks to generate this, right? So CrowdStrike is still open, EEM is still open, still holding to that. Let's look at CrowdStrike. Like I said, I'm bullish on CrowdStrike. I want to do it a naked put just to conserve the buying power capital so that I can use that capital for other trades. So I did a wide $50 wide put spread. So far looks okay. Barely making some money, 60, 70 bucks. I'll wait. If market cooperates and if I'm able to close it at, I think I already have a closing order for it, gets closed at the profit target, great. Otherwise, we roll it to the next expiration period. Or if it gets assigned, I have no problem in holding CrowdStrike. I don't have any CrowdStrike in my portfolio. So this is a one way to try to get it at a lower than the market price. So I opened it when the CrowdStrike was at what, 277. So it was here. So now it has fallen down to 260, but still our break-even point is close to $250. So I have still have a lot of room. EEM, that's one that has fallen way down because of China. EEM is one ticker that I generally wants to always a position in because from a diversification perspective, right? It's a emerging markets ETF. So I did a bullish trade on EEM, gives a diversification of our portfolio. Stock was at 53.40 cents at that point of a time. It wasn't at the money because I had no positions in ETM or EEM. So it will be okay if get assigned. But from 53.40, I think I did it right here. Who knows what happens on after that? And all the China crackdown. China is, I think, 25% of this EEM. And now it's about to recover. So it's down at 50.73. My cost basis will be $52 for this one. So if it higher than 52, it will be profitable. Otherwise, we'll sell call on it once it get assigned, convert it into a covered call trade, and sell another put, because I still want to have position on the emerging markets. New one for this week is Disney. We did it on 24th, that is Friday. Sold a strangle in Disney. I hold long position. So it is, for me, it's covered on the call side. So this is building our November portfolio. I hold 100 shares, sold 165 put and 195 call. The break-evens on the call side is within the expected move. It's outside the expected move. On the put side, the break-even is 162, close to 160. Oh, sorry, 161. Won't mind buying Disney at this cost basis. 161. I think for me, Disney is a stock that I can own if the economy is closed. Also the stock that I can own when the economy is opened. So for me, getting a sign on Disney and buying more of a Disney at 161 is a decent bargain for me. And if it goes high, gets called away at 195. I've sold enough premium on Disney. My cost basis is currently less than $100, even though I acquired at 139. But overall, if I look at the Disney and the premiums that I've sold, it's less than 100. So getting called away 195 won't be such a bad idea either. And we'll get back into Disney, by selling puts again. So if it stays in between, like I had done in the previous instances, I'll continue to reduce the cost basis, right? This is how every month you reduce it by $2, $3. I mean, you're just you are generating a percentage or a 1.5% on Disney on your own, right? Do it 10 times a year, you make 12%. Without, even if the stock doesn't cooperate, I mean, without not considering the additional gains that you may have because Disney paid dividend and the stock moved up. So yeah, some of these are my very regular trades against the long holdings is premium harvesting. So that was the additional new trade wanted to talk about. Overall, we talked about 58 trades. 10 of them we lost. And 45 we have closed. So 3 are still open, which are these 3. That brings us to the end of today's session. So now let's get back to our questions. So, and if you want to drop off, feel free. I'll just address some questions, hang around, maybe discuss something else, discuss crypto if you want to, or any other stock. Remember I said Disney have started paying dividend for now. I think during the COVID, they decided not to pay. You're right. Look, Disney is an evergreen stock. I should have looked into Disney years ago. I only started getting into Disney last year. But again, it's never too late for great companies, right? Like I said, Amazon, I got in at Amazon at $1,600. Thought I was too late. But it's never too late to get into companies which are great. Samuel, thank you for getting to understand crypto action. You're most welcome, Samuel. Zifty has a question. Newbie question on crypto private keys. Does your entire BTC or ETH have one private key? Or does each partial holding you send or move to BlockFi create your own private key so you can decide what to do with certain portion then portion of your holding after you transfer. So if you are transferring anything to BlockFi, you don't even hold the keys. It's a BlockFi that has got a key. So once you've transferred it to BlockFi, it's a BlockFi who has the key, not you. But to answer your question, if I am holding a self-hosted wallet, or maybe your question could be from BlockFi perspective. So the exchanges or BlockFis could hold it in one wallet, could hold it in multiple wallets. It's up to them. On an individual level, you can actually create as many wallets as you want to, but for our convenience sake, I might want to create one wallet and hold it, let's say one BTC wallet and hold it until that becomes to a certain amount, beyond which I want to spread it and create another BTC wallet. So as an individual, we can take a call, we can decide on how we want to do it. Definitely multiple addresses, I would definitely want to do it. Because then they can't figure out, for example, if I always use one address to transfer, then you would know, okay, how much is a particular person is holding in this wallet against that one address, right? But if I use multiple addresses to transfer, and you can just generate a new address, is pretty easy on the wallets that you hold, then even though it is public, you may not, unless you do a lot of forensics, this is not easy for someone to figure out, okay, who's holding what. Zifty, also there is no such thing as tax lots on crypto holdings yet, right? Want to be able to buy, sell different tax lots for tax management. Is the capability not available for cryptos anywhere? Is there anywhere to get around this? Yeah, so no crypto exchanges provide any tax lots capability, but you could decide in terms of how you want your, again, I'm not a CPA, so don't take it as a tax advice, but based on what I have read, you could decide and tell IRS that I want to be taxed on FIFO basis or on LIFO basis, right? And then you have to track, if you've sold a particular asset, when did you buy it, based on FIFO or LIFO logic. And then you can, in your tax return, you can tell, okay, this is the gain based on that. But the tax lots, I don't know, this is treated as a property. So does the tax lot, how does that apply to it? Yeah, I'm really not sure. Can you pick and choose and say, settle this against this particular incoming transaction? I don't know. I know you can, I read that you can do LIFO or FIFO or HIFO. I don't know if actually someone does HIFO, which is highest in, first out. I would actually want to do that, but no, I don't really see. I have to maybe talk to CP to understand that. But there is no wash rule on crypto. But I think in infrastructure provision against some crypto regulations, the regulators are planning to add these wash sale rules to the crypto. So it will become applicable to cryptos in 2022. Today, there's no wash sale rules for crypto. So if you bought a crypto which is now in loss, you want to take a loss and take a break, reduce your taxable liability and buy it immediately after taking a loss, you can do it. Just sell it, take a loss and buy it back. If this is, I see you can have a different wallets on BlockFi for different tax lot. So I don't know, if you move it to BlockFi, right? They don't give you different wallets. When you open your account on BlockFi and you say, I want to transfer BTC, or you create a wallet on BTC, or maybe they do, I haven't checked. But if you create a wallet on BTC, you have that. Can you create more than one? I have to check Zifty. I never tried to do that on BlockFi, more than one wallet. Because for me, it's any number of wallets I create on BlockFi, all of them are controlled by BlockFi. I don't control private key for any one of those. So from a security perspective, didn't really matter. But let me take a note to check on BlockFi. And maybe this something I can answer it on our Thursday call. If you can create a multiple wallets on BlockFi or not. Cool. Any other question? Anything else? Any new stuff trying? New adventure? One of the, I think Stitch Fix was did good after earnings. It always moves a lot after earnings, but this time it moved up. Sometimes it moves down after earnings. Cool. All right, no further questions. Then let's. Yeah, it is a nightmare. It is a nightmare. That is why I generally don't engage in too much of a trading on the crypto assets, because the exchanges are not going to give me the what do you call the tax document at 1099B. It's up to me to figure out that if I sold this crypto asset, when did I buy it? And I can sell partially. You know, if I bought it, say 1.5, I might be selling 0.69 in this transaction, then point, and then another one, in some other transactions. That it's a nightmare. I agree with you. It's a nightmare. That is why I generally don't do too many transactions on the crypto side of the house. If 1099B comes in, I might be more willing to sell something. Right now it's diamond hands, as they call in this language of Wall Street bets, diamond hands. What's the opinion of BKNG? That is Booking Holdings. It's a great stock for long-term ownership. We'll go back and BKNG. This has, so from a company perspective, I think this is it's continuing to be a good stock to hold on. Short term, it's gone up. Did it have earnings? It didn't have earnings, but I think all the economy reopening stocks have now benefited. In recent times, we saw Carnival stock going up. Airline stocks performed well this week. Live Nation and the other event stocks performed well this week. Similarly, Booking Holdings are done great this week. I think this is a great company to own, and good company to own for long perspective. It's got a pricing power. It's got a market share. It's the market leader in online booking and all that. So can go wrong. Again, should you put everything at this price point? No, always divide and enter. So if you don't do options, then maybe follow 1/4 rule, right? If you have $10,000 to invest for this particular stock, maybe do 2,500. Wait for what happened in the next earnings result, which is over here. Do another one. Try to dollar cost average, because we don't know short term. Tomorrow we figure out that in the winter, the Delta variant and the COVID, we start to see these cases going up in fall. These things could easily come back down, but that doesn't impact anything on the long-term basis, right? So if you are, buy it in in pieces. But if you trade options, I would rather, sell a put spread on it and then wait. My friend uses soft wallet to keep track of crypto outside. Do you recommend it, or do you have experience with? Yeah, so soft wallets are available depending on what assets you have. So there are a bunch of soft wallets. Exodus is there, Electrum is there. I would highly recommend to use it to move your digital assets outside of the exchange. So once, if your assets become big enough that you will lose sleep, if those assets vanish from your portfolio, then it is advisable that you could move it out. But then you have to be responsible, because now you are responsible for holding your own digital assets. So you could move it to the soft wallet, or you can move to a hardware wallet. I have experience with both of them. For soft wallet, I use MetaMask for Ethereum and ERC20. And then, but most of it's in hard wallet, because again, I don't trade too much in and out. So I don't have to keep it on the soft wallet. So it's mostly on the hard wallet. And then of course, it's on exchange, but once you're on an exchange, it becomes big enough that I start to get worried. What if my account gets hacked? Like today, first thing we saw, right, the Coinbase stuff. What if I had not paid attention and log into that scam site, and then somehow they do a SIM swap, SIM swap attack on my mobile phone? Then someone gets an access to my Coinbase account, can drain my wallet, and there is no way I'll ever be able to recover it. So in that case, if that becomes too big, I'm like, I'll move it to outside of a Coinbase, move it to a hardware wallet or a software wallet that I control. So yes, it's a good way to take custody of your own assets. Cool. Anything else? Any other question? All right, so that's it for today. And next week, I want to do a deep dive on one company. I think it's been now 3 or 4 weeks. So I want to build a cadence to do a deep dive on some company after every few weeks. So we'll do a deep dive on one company next week. Is it safe to buy Ledger on Amazon? I would say no, go to Ledger website directly and buy it from Ledger website. You might get a little cheaper on Amazon, but I don't know who is selling on Amazon and if that key may be tampered. So why take that risk? And it could be safe, but I don't want to take the risk. I would directly buy it from the manufacturer. Pay whatever Amazon might be doing their own filtering and trying to remove the scam merchants, but things fall through crack. So when it comes to this crypto, where there is no, no U-turn, if you lose it, there is no way to get it back. There's no 800 number you can call. It's why take that risk to save a few dollars? Ramesh, thanks. Thank you, Ramesh. Yeah, I missed as well last week, because now this has become a routine, and I love doing this. I enjoy doing this. So last week I missed meeting you all. Soren wrap doesn't mean anything. What is that? Zifty, I'm not heard. What is the Soren wrap? Oh, let me search. Or did you have a typo in this? Ledger. Sorry. No, so if you're interested in Ledger, buying the I would recommend go and buy from Ledger company directly. Or even if the Amazon box is sealed. Oh, okay. If the wrapping is still intact, right? Oh, can someone not rewrap it? I mean, I'm not saying that it could be fake. You could take it, but the question is when you're dealing with this, you have to make sure that the key has not, the passphrase has not been generated prior, right? You have to generate the passphrase when you receive this. If it comes with a pre-created passphrase, then just break it. Just throw it away. Then it means somebody has already used it. And if you use it, the person who has already used it will be able to move all your money. It's like they know your password and telling you this is a password for your bank account. I'll never use that password. If someone tells me that, I will basically create my own password. So yeah, so if it is sealed and it doesn't come, and when you try to instantiate this and it tells you to take note of it for the first time, then yeah, then it is genuine. Then it means it hasn't been tampered with. But I have read through stories of folks who had bought and got the tampered ones, and then they moved the funds into that wallet address, and then suddenly their wallets were drained. So I'm like, I'm not even taking that risk. I'll just buy it on directly from LedgerX. Cool. All right. Thank you, everyone. It was fun talking to you after a gap of a week. So thank you as always for coming here and helping me with these discussions. So let's talk again next week. And if you're attending or interested in crypto, we meet on Thursday, 6 p.m. to dig deeper into crypto. Today I spent 10 minutes. We do 90-minute sessions just on getting into the details of crypto. Like we do a stock review, company review. We do a crypto project review. You guys have a wonderful weekend and a nice week in the markets. Nowadays, I don't even know what to say because profitable doesn't matter. 1 week profitable, next week not profitable, right? So I hope you enjoy staying in the markets. Let's have fun. Bye-bye.